Very good afternoon, everybody. You're not all going to be replaced by robots. I don't want to scare people that much, but it's a great pleasure to be back here again. It's my 14th plenary at Super8 in a row, so I'm aging myself here. I feel like I'm part of the furniture by now. And I'm going to want to give it a little angle this afternoon, because obviously, like everywhere else in the world, we spent a lot of time the last couple of days discussing implications of AI, implications on the companies private equity firms own, on venture capital, and how things have been administered. I want to take this a little bit into what this conference is about, asset allocation, matchmaking between LPs and GPs, and try to address the question of what may actually be in this asset class, happening in this asset class in the very near term. So I labeled the speech "Machines at the Gate," and I want to be sure the allocators in the room are ready to be prepared for what may come your way in terms of disruption of the very heart of how this asset class works. Those of you who know me and my work a little bit, I'm happy to see several clients here in the audience. I'm passionate about understanding private equity performance drivers as an academic. I'm particularly passionate about understanding those drivers that reside with the fund manager. And we created the analytics business some time ago to basically shed some lights on the conundrum that most of the fund managers that you're meeting out here are basically telling stories about being top quartile, risk mitigant, differentiated. It cannot possibly be true for all of them, and even if it is, it's difficult to see, how this helps you find the right match with your portfolio. People have different approaches to identify for whom this is true or less true. I'm an empiricist. I like to throw data at things, so we came up with a relatively deep set of analytics that's designed to identify very distinct skills that fund managers may or may not possess that are basically readable and identifiable in the track record of these firms. And so we try to bring the industry to a world where it's going to become more second nature, that whenever you hear certain statements about characteristics of GP, approaches to value creation, you kind of know where to look on the data to substantiate those claims. And the business has been out there for some time. We had the privilege of partnering with phenomenal other players in the asset class in order to disseminate some of our approaches and metrics. I would take particular pride in the statistic here, where we can basically demonstrate that among those GPs that trust us with their data and allow us to run numbers on them so they can present themselves more objectively in the fundraise, we have a substantial upward bias. It's year on year the best private equity firms, the outperforming private equity firms that work with us. No causation implied, of course. We don't make them great, but obviously the best private equity firms have even more reason to come to us so we can try and document the sources of their success. So our clients are outperforming and outgrowing the average of the asset class. Now, you heard me talk about themes like this in the past, which were all about putting smart data in front of human decision makers to lead to better investment outcomes. I'd like to take this to the next stage today and basically see what we can imagine as a world if we were to leverage that wealth of smart data, not big data, but smart data and private equity, with these enormously powerful tools of machine learning. And this is different from the AI that gets talked about so much. This is not generative AI. This is predictive forecasting with more or less old-fashioned algorithms and statistics to identify better decision outcomes. And I was standing up here 7 years ago, giving a keynote about what was labeled at the time the tools of the future of private equity, trying to giving people a feel for what may be ahead of us in the longer future, because at that time, I started to experiment with these techniques of machine learning. And the key takeaway at the time that's equally relevant today is really, if you look at the driving forces of success in private equity at the deal level, at the fund level, our mind has to accept that the simple relationships that at least I can follow no longer work. It's not about a simple regression line or even a nonlinear relationship, about a simple decision tree. The interrelationships that drive performance between a multitude of factors have a complexity, as you see in the neural network sketch on the lower right-hand side, that surpasses the human brain. At least I can no longer figure out interaction effects of 99 variables or features. So we gotta let go, and we gotta at some point trust the machine to give you the right answer and the right prediction. There's a big danger with that I mentioned already back in the time, but it's so important I want to bring it up again, and that's the danger of what's called false generalization. These tools are so super powerful, there's a danger they find something in nothing. They will generalize from certain data sets things that are not actually relevant in the future in other data sets. And I always like to illustrate this with my good mother, who was a high school teacher. And imagine the first class she ever taught in. had the smartest student being a chubby redhead boy. Now, she may leave this class after first year's thinking that being a bit obese, male, and having red hair is actually related to outperformance in the classroom. But sure enough, she learned nothing. The next class, the smartest student was a slim brunette girl. So that's false generalization. That becomes very dangerous if these tools of machine learning are so enormously powerful that they suggest they can perfectly explain data, but you learn nothing. So the test that you always have to apply whenever somebody proposes you a great algorithm is to see, does this work in unknown data? Does this work in an out-of-sample test? If you don't do this step, artificial intelligence will turn into artificial stupidity, super powerful, but very stupid nevertheless. So obviously, everything I'll present to you in the next 20 minutes will be out-of-sample tested, applied to data that the algorithm has not seen, and I think we're going to see something really cool. Now, let me be clear. There's a natural tendency, if you think about any disruption, in particular AI, to think, oh yeah, that will affect everybody but not me. And I'm guilty of this. Right? It's my day job. I'm a university professor. I do lots of executive training. Whatever new technology comes up in the classroom, I go like, yeah, that's going to disrupt the other part of teaching. Our premium interaction, seasoned executives in a classroom with a professor, you can never replicate this. Well, in my brain, I know this will change. It will alter. I just refuse to accept that this will be replaced or improved by a world that I cannot imagine yet. I like to put the same challenge to you as private equity allocators. I do believe the tools are ready right now to lead to better decision outcomes in some of the key aspects of what you do as an allocator that may be superior to human judgment, or more importantly, be enormously impactful when empowered by and integrated in human judgment. And so I would like to argue today that machine-based learning tools are ready to take better decisions than many allocators can do in primary fund selection, to take better decisions than many human actors can do in the challenge of pricing secondary fund stakes, pricing fund stakes in the secondary market. And so I firmly believe in the very near future, these type of tools are going to revolutionize the way the private equity industry works at its heart. Now, why am I worrying about these topics? Why do I think we're nicely positioned to do something here? I've been living and suffering with private equity data for 25 years, probably seeing more of this than many, both through the university work and then through client work. And if I go back in time, my passion to build predictive forecasting models for private equity actually dates back to a 2007 publication. There was a relatively simplistic multivariate statistic methodology by today's standard, but I played around already back then with ways to see how do we use data to find winners in primary fund allocation. Some of you may have seen the work I've done over the years that try to capture different dimensions of GP skill, be it the rankings we're doing with Dow Jones and the Wall Street Journal on private equity performance rankings for GPs, or the Hall of Fame of value creation. So I've been well positioned, thanks to this research, to now be looking back at a very exhaustive data set. And that data set does not only encompass the usual stuff, the fund level returns and the deal characteristics, but it goes into more original data types. I have the census of every investment professional who ever worked for a meaningful GP in the world. 20,000 people. I know where they work, how they move, how they got promoted, how diverse they are. Very powerful in explaining possible value creation. We're bringing in social media content on both the GP and social media sentiment on both the GP and portfolio companies, and lots of other original data that very likely influences the key decisions we want to take. Now, whenever you hear data and machine learning, you think big data, and you probably wonder, how can you possibly do something on private equity? Because granted, there's only a few hundred funds being raised in a given year that you have data on that you can backtest. Now, there's a growing toolbox within the overall arena of machine learning that is designed specifically to derive generalizable insights from relatively small data sets. Not going to bore you with the technicality, but that's a toolkit that we've been very selectively grabbing things and techniques from and apply this to that private equity type data. And what we've built over the years is basically ready to go in 4 areas. Primary fund selection, the pricing and valuation of secondary fund stakes, LP-led, that is, the assessment of co-invest opportunities, and then the assessment of GP-led secondaries. I got time today only to go into some level of depth in the first two, but the research continues, and we're basically pushing all four of those. So let's imagine a world where we had at our disposal the algorithmic gatekeeper. Well, let's actually imagine a world in which we had this on our disposal some time ago, because I want to show you the performance impact that would have had. So let's turn back the clock. Let's take models that were derived back in 2015, 16, 17 on data available then, and imagine that would have been at the disposal of US public pension funds, which are a nice fruit fly to pick on because they conveniently put everything they're doing in the public domain thanks to FOIA. So we can imagine a world at which the LPs would have had those tools at their disposal and actually acted on them. And we'd like to see within these pension funds how performance would have been different had they listened to the tool. And I want to be realistic here. I don't want to assume they invested all in the one fund identified as the best of the world, but I'm just looking at their existing portfolios and I'm reshifting commitments a bit more here, a little bit less there, within the managers they actually invested in. So I want this to be as realistic as possible as an exercise. So how do we build a model for primary fund selection? We turn back and forth the clock. We look at lots of historic fundraising events, gather tons of data that's available at the moment of time where this fund came to market, and train a model going back and forth that figures out how does this range of different factors predict the future outcome, predict the performance of the fund to be raised. Now, very happy to go offline into more depth of this. Behind this is a rather powerful proprietary algorithm that I designed with my team in order to go through these data points and find the joint impact of those 99 different features in a reliable way so that we can actually build a model that says, okay, this fund is likely a winner, this fund is likely less of a winner. Now, that'll inform the fund selection, and here's the simulation that we basically ran. I'll look within the US public pension schemes at those that committed in any given year at least $1 billion to the type of funds I score, because I want to not focus on the outliers. I want to go to the 17 volume players out there. For each of these 17, we say, let's look in the year what they've actually done. Let's ask the algorithm, what's the predicted performance of each of those funds based on a model that could have been applied at the time, and then see how performance would have changed had they listened to the model. In a formulaic way, those things that are predicted to perform really well get a higher allocation. I also wanted to try out how the more idealized world would look if they had just invested in the 10 best fund recommended by the algorithm in a given vintage here, and then we compare performance. We're not even considering that they would have saved a lot of money in gatekeepers' fees in the process, so we're only focusing on the performance impact. So I'm not picking on anybody in particular. This is California Public Employees Retirement System, someone I grabbed randomly. According to the data I have access to, these were 7 of their commitments in 2018, and you have the actual commitment year and the fund size here. And you're familiar with most of these names, nothing overly esoteric in there. Let me create a world in which they had not invested as they did, but they had listened to the algorithm. The algorithm says there's a certain machine learning score related to predicted performance, and then we're recalibrating, we're revising the commitments. So in some of the funds, we say we give it a little more because the score is high. On some of the funds, says we give it a little less because the score is low. Forgetting all other parts of diligence and assuming just that element. And let's see what the performance outcome is. First of all, how does the prediction correlate with the actual multiple of those funds now 6 years later? That's good. There's a 30% correlation, so we have a bit of predictive power here. And we're getting 6 cents on the dollar TVPI excess performance. Now, I got to be honest, we don't always get it right. There's some funds where actually it would have been better had they invested the old way. The recalibration was not strong. But at the portfolio level with this example, in this year, there would have been outperformance. Outperformance in multiple, outperformance in cash on cash. So that's always what we want to check. Now let's repeat the same exercise. We're doing this for all 17 funds. We're doing this for all 6 vintage years we're looking at. This is the outcome. This is the TVPI gain in cents on the dollar invested of my 17 public pension schemes. For some, it's a dramatic improvement. For many, it's a meaningful improvement. And for some, it's flat. Had the US pension plans possessed that tool, as of today, they would have been $7 billion richer. That's no pocket change. They are a volume of $96 billion committed in that time. We're talking 6-7 cents on the dollar outperformance. Now, that's the prudent approach. If I take it one step further and said, had these pension schemes listened to the algorithm and only committed in every given year to the 10 funds identified as the top performers in the future, this would have been the chart. Substantially higher investment across the board, 15 billion of outperformance in terms of TVPI. And yeah, of the 15 billion today, 9 billion would have already been cash returns. So I'm not just generating paper gains. This is $9 billion, 10% of the entire commitment available to pay pensions and reduce the underfunding problem. So I hope you get the feeling that the pure algorithmic approach has enormous power, and at least in those cases would have led to clearly superior investment outcomes compared to what the actual decision makers have taken. And again, I have to be honest, there's one pension scheme who was phenomenal, and they actually generated in the real world 4 cents on the dollar outperformance compared to the algorithm. All the power to them. The 16 other pension schemes would have been substantially better off. So that's what I have built on the primary fund selection. I'm actually at least equally excited about what we can do on the secondary fund stake pricing, where we're basically built a model by simulating hypothetical trades in the secondary market, looking at a fund that could have been acquired at a given point in time, and then looking at the entire history, not only the fund acquired, but the fund before and after, in order to gain insights in what may inform the future value appreciation. And that's an intentional different approach from what most of the incumbents are doing in the space. All my friends who are doing secondary investments for a living tell me, well, you got to look at the underlyings. You don't have blind pull risk. Look through the funds. We value the assets bottom up. That's our skill. That's surely a great skill. But at some point, I look at this as very laborious, and you're just second-guessing the GP. Because the GP already gives you a NAV, and I don't think that's always 100% the actual value, but I rather understand what's going on with the GP, what reasons does he have to be optimistic or conservative in that NAV, and what's likely going to influence that value evolution going forward. Because I had the privilege of working with some real-world data on transactions in the secondary market. And I could test whether the incumbent's approach works out. And I'm regressing here the price paid over a bunch of secondary transactions and the going forward value, so the return to an investor on those fund stakes at par. And the scatter chart basically means there's a non-correlation. The good stuff is as highly priced or lowly priced as the bad stuff. It's actually all over the place, which creates a beautiful arbitrage opportunity. If we were able to identify the funds who yield low returns going forward but trade at high prices, I'd love to share this information with my LP friends because you would know what to sell. You get good prices, you don't leave much money on the table. Equally, there's a great opportunity to price arbitrage on the other end because as an actor, as a buyer in the secondary space, you could pick up fund stakes at low prices, which generate very high go-forward TVPI. Now, how can I build the model that arbitrages here? I got to take a fundamentally different approach. I'm not going bottom up. I'm purely reasoning top down based on the thesis that 100 million NAV that's for sale somewhere will very much depend on its value going forward on stuff that's going on at the GP and the fund level. Let me give you one piece of intuition here. Imagine that 100 million is an older Crestview fund. Crestview used to do oil and gas investments. They no longer do. That's public information. I look at this and I say, very likely that 100 million will evolve differently going forward than the same assets, 100 million, in the hands of another GP, because chances are the Crestview partners who are really good at doing oil and gas are either gone or demotivated or retrained to something else. And those assets may be more neglected. Now, the challenge is, of course, how can you possibly codify and operationalize these things. And that's an extract from a presentation I gave at Super Investor back in 2016. I've done a lot of work for many years on how to measure those GP and fund level factors, which will likely influence the value appreciation of funds in the second half of their life. So with this setup, we can basically go in, simulate this large number of secondary fund stakes. Again, draw on my data over 20 years plus private equity to come up with lots of variables that will likely influence the value appreciation of that unit of NAV, apply the same type of proprietary algorithm, and see what can we do to build a model that will predict with some level of accuracy the go-forward value of that secondary fund stake. Now, how can we test this? The beauty is, again, we can leverage data I have on real-world transactions. This is not rifle shots of individual trades. These are portfolios that I'm bidding on, to be a bit more realistic. And I'm bidding on the part of the portfolio that the algorithm can price. It's about 80% by value. I got to ignore the other for my backtest. And the rule here is that I'm applying, again, in every given year on a transaction that has taken place in 2018, I'm applying the algorithm built in 2017 data. So I'm honest with my kind of out-of-sample testing. And then I'm aggregating the performance as if we had built a secondary fund. Now, there's lots of stuff the algorithm was bidding on. And my rule was basically, I'm going to bid in order to reach a 17% target IRR with a certain lower bound. You can alter with this, but this is the outcome. Over the years 2018, 19, 20, 21, 1.5 billion deployed. With a conservative assumption with respect to leverage and so forth, this is a roughly 2x secondary fund. And if I look at how that quartiles in the broader area of secondaries, this is the upper quartile threshold in those years. This is the performance of those funds. So we got ourselves a winner here. And again, I'm being realistic in the sense that these were real-world transactions, and I've been bidding away my entire pricing. So if I say I can bid 95 cents on the dollar to get 17% IRR, I assume I paid 95 cents on the dollar. Well, in the real world, I probably would have figured out the others are at 85, so let's bid 87 and make this much more powerful. So just as I hope I demonstrated on the primary fund selection, very powerful tool here in the secondary market that has an enormous potential to arbitrage on the buy side in this market and pick up fund stakes that are clearly mispriced. Now, I mentioned to you I have similar kind of methodologies for GP-led secondaries and for co-invest. No time to go into here, but you get the picture of what can this do in terms of the power of it. And so with this in mind, take a minute and reflect what's going to change in this industry going forward. We had a lot of thoughtful comments here about AI, not so much characterized as how much does this replace everybody. It's not about replacing jobs, but it's about empowering the human decision maker. How much more efficient can you be in serving your constituents by leveraging those tools to find the most attractive opportunities out there? Because I firmly believe in whatever's going to happen in the future, the AI piece can only remain one piece of the puzzle. We're going to surround this with human decision making. We're not building the autonomous self-driving Waymo car. We have a really powerful Tesla, Porsche, Mercedes with a good drive assist system, but the human actor has to have their hand on the wheel. And just in closing, the setup methodologically, just in line with what AI can do elsewhere, allows us to do really cool additional things. We can customize the outcome. We can build portfolios that truly are trained to deliver alpha versus cash-on-cash return versus a short payback period versus downturn resilience by training on those features and giving ultimate investors in a much more nuanced way products that currently cannot credibly be built in private equity. So I'm out of time. Thank you so much for your attention. Been on this for 25 years, and I'm excited to get going soon and actually deploy capital on this. Thank you very much.